I am Dr.S.Chandra, Assistant Professor, PG and Research Department of Commerce, Sri Sarada College for Women, Salem. Today we are going to discuss issue of shares. First we discuss what is share. The capital of a company is divided into shares. Each share forms a unit of ownership of a company and is offered for sale so as to raise capital for the company. What are the types of shares? Shares can be broadly divided into two categories: equity shares and preference shares. Equity shares give their holders the power to share the earnings or profits in the company as well as a voting rights in the annual general meetings of the company. Such a shareholder has to share the profits and also bear the losses incurred by the company. So preference shares means the holder of the preference shares only they earn dividends which are also fixed and giving no voting rights. Then we discuss what are the types of equity shares or what are the classification of equity shares. We have classified the equity shares under three categories. The first one is classification of equity shares based on share capital. Under these classifications, we have classified the share capital into four categories. The first one is authorized share capital. Every company in its memorandum of associations requires to prescribe the maximum amount of capital that can be raised by issuing equity shares. The limit, however, can be increased by paying additional fees and after the completion of certain legal procedures. The second one is issued share capital. This implies the specific portion of the company's capital which has been offered to investors through the issuance of equity shares. The next one is subscribed share capital. The portion of the issued capital which has been subscribed by the investors is known as subscribed share capital. Paid up capital. The amount of money paid by investors for holding the company's stocks is known as paid up capital. As investors pay the entire amount at once, subscribed and paid up capital refer to the same. The next classification is based on definition. Under it, we have four types of shares. The first one is bonus shares. Bonus share definition implies those additional stocks which are issued to existing shareholders free of cost or as a bonus. The second one is right shares. Right shares mean is that a company can provide new shares to its existing shareholders at a particular price and within a specific period before being offered for trading in stock markets. The third one is sweat equity shares. If as an employee of the company you have made a significant contribution, the company can reward you by issuing sweat equity shares. The last one is voting and non-voting shares. Although the majority of the shares carry voting rights, the company can make an exception and issue differential or zero voting rights to shareholders. Then we classified the equity shares based on returns. Based on returns, we have three types of shares. The first one is dividend shares. A company can choose to pay dividends in the form of issuing new shares on a pro rata basis. The next one is growth shares. These type of shares are associated with companies that have extraordinary growth rates. While such companies might not provide dividends, the value of their stocks increases rapidly, thereby providing capital gains to investors. The last one is value shares. These type of shares are traded in stock markets at prices lower than their intrinsic value. Investors can expect the prices to appreciate over some time thus providing them with a better share price. The second type of share is called as preference shares. Preferential shareholders receive preference in receiving profits of a company as compared to ordinary shareholders. Also, in the event of liquidation of a particular company, the preferential shareholders are paid off before ordinary shareholders. Then we discuss types of preference shares. Totally we have 8 types of preference shares. The first one is cumulative preference shares. In the case of cumulative preference shares, if a particular company doesn't declare an annual dividend, the benefit is carried forward to the next year. Non-cumulative preference shares. Here the benefit doesn't carry to the next year. The shareholders receive their dividends in a current year itself. The next one is participating preference shares. Participating preference shares allow shareholders to receive surplus profits after payment of dividends by the company. This is over and above the receipts of dividends. Non-participating preference shares. Here the shareholders carry no such benefits apart from the regular receipt of dividends. Then convertible preference shares. Convertible preference shares can be converted into equity shares after meeting the requisite stipulations by the company's articles of association. Non-convertible preference shares. Here the shareholders do not have any option to convert their preference shares into equity shares. Redeemable preference shares. A company can repurchase or claim redeemable preference share at a fixed price and time. These type of preference shares are sans any maturity date. Irredeemable preference shares. On this type of preference shares, we are not get back the amount during lifetime of the company. We get back the amount only at the time of winding up of the company. Then we discuss steps for issuing the shares. The issue of shares is the procedure in which enterprises allocate new shares to the shareholders. Shareholders can be either corporates or individuals. The enterprise follow the rules stipulated by Companies Act 2013 while circulating the shares. Here we follow 3 steps. The first one is issue of prospectus. The enterprise initially issues the prospectus to the general public. The prospectus is an appeal to the public that a new enterprise has come into the presence and it would require funds for operating the trading concern. It comprises of complete data regarding the enterprise and the way in which the money is to be collected from the prospective investors. The second step is called receipt of applications. When the prospectus is circulated to the public, prospective investors contemplating to sign up and subscribe the share capital of the enterprise would make an application along with the application money and deposit it with a scheduled bank as mentioned in the prospectus. The last stage of issue of shares is called as allocation of shares. Once the minimum subscription has been done, the shares can be allocated. Normally, there is always oversubscription of shares, so the allocation is done on pro rata ground. Letters of allotment are sent out to those people who have been allocated their part of shares. This results is an authentic contract between the enterprise and the claimant, who will now be a part owner of the enterprise. Then we discuss modes of issue of shares. The first one is issue of shares at par. It means to issue the shares for an amount equal to the face value of shares. For example, if the face value of shares is rupees 20 each and they are issued at rupees 20 each, then it will be issued of shares at par. The second one is issue of shares at a premium. Issue of shares at a premium means to issue the shares for a value more than its face value per share. For example, if the face value of shares is rupees 20 each and they are issued at rupees 25 each, in its the difference amount rupees 5 is called as premium. Issue of shares at a discount. When shares are issued at a price lower than their face value, they are said to have been issued at a discount. For example, if a share of rupees 100 is issued at rupees 95, the difference amount rupees 5 is called as amount of discount. It is a loss to the company. Then we discuss what are the types of subscription. We have 3 types of subscription. The first one is full subscription. Company may receive applications equal to the number of shares company has offered to people. It is called full subscription. Oversubscription. It is referred to as the situation where the company receives more applications from share buyers than the number of shares made available for public. For example, if a company receives 10,000 applications against their 6,000 share, it can reject the remaining 4,000 in case there are any discrepancies. Under subscription, it is referred to as the situation where the number of shares applied by the public is less than the shares that are issued by the company. For example, a company gave 50,000 offers to people in general and the company got applications for 40,000 shares from the general public. This situation is called under subscription of shares. Then we discuss procedure of issue of shares. Face value of a share is the par value of the share. It is also known as nominal value or denomination of a share. To issue shares, a company follows a definite procedure which is controlled and regulated by the Companies Act and Securities Exchange Board of India. There are different ways of issue of shares which may be. The first one is for consideration other than cash. The second one is for cash. First we discuss issue of shares for consideration other than cash. Sometimes shares are issued to the promoters of the company in lieu of the shares provided by them during the incorporation of the company. The issue price of these shares is normally debited to goodwill account and journal entry is made as follows. Goodwill account data to share capital account. In case a company does not have sufficient funds for the purchase of fixed assets or for payment of creditors, it may offer and allot its shares to vendors or creditors in lieu of cash. In the case of purchase of assets like building, machinery, stock of materials, we make the journal entries like assets account data to vendors or creditors account. The second entry is vendors or creditors account data to share capital account. Then we go to discuss the second procedure, issue of shares for cash. Company may call the share money either in one installment or in 2 or more installments. Receipt of share money in one installment means first we write the entries for receipt of application money, bank account data to share application account. Then we transfer the application money into share capital account. We write the entries like share application account data to share capital account. Then allotment money becoming due and received. In this case, and on the allotment of shares, the amount receivable on the next installment, that is on allotment becomes due, we make the entries like allotment money becoming due. For that purpose, we make the entries like share allotment account debtor to share capital account. Receipt of allotment money, we make the entries like bank account debtor to share allotment account. Then we discuss calls on shares. After the receipt of application and allotment money, the money that remains unpaid can be called up by the company as and when required. Thus, a call is a demand made by the company asking the shareholders to remit the called up amount on shares allotted to them. The company may demand the remaining money in more than 2 installments. The amount called after the allotment is known as call money. There may be one or more calls depending on the fund requirements of the company. When only one call is made and the call money is due, the entries like share first and final call account debtor to share capital account. Receipt of call money, for that purpose we make the entries like bank account debtor to share first and final call account. We discuss one simple problem relating to issue of shares. First, we explain the problem relating to this issue of shares. Fashion Fabric Limited issued 1 lakh shares of rupees 10 each on 1st April 2014. The amount payable on these shares was as under: rupees 2 per share on application, rupees 3 per share on allotment, rupees 5 per share on call. For here, the number of shares 1 lakh shares, value per share is called rupees 10, application money rupees 2, allotment money rupees 3 and call money rupees 5. First, we make entries for receipt of application money. For that, debit the bank account and credit the share application account. Then we put the amount 1 lakh into rupees 2, that is 2 lakh rupees in both debit and credit side. Then we transfer the share application amount to share capital account. For that purpose, we make the entries like share application account debtor to share capital account. Then write rupees 2 lakh in both side, that is debit and credit side. Then we make the entries for allotment due. For that purpose, we write the entries like share allotment account debtor to share capital account. Here 1 lakh shares into rupees 3, so we get the amount rupees 3 lakhs. We debit and credit these 3 lakhs in this entry. Then we receive the share allotment amount. For that purpose, we make the entry like bank account debtor to share allotment account, same 3 lakhs rupees in debit and credit side. The last one is we receive the first and final call amount. For that purpose, we make the due entry. Share first and final call account debtor to share capital account, 1 lakh shares into rupees 5, so we get rupees 5 lakh. We debit and credit these 5 lakhs in this entry. Then we receive the share first and final call account. For that purpose, we make the entries like bank account debtor to share first and final call account. So here also we debit and credit the rupees 5 lakhs in both sides.